Notes receivable are written promises to pay and usually have interest associated with them. They can arise when companies lend or borrow money, if amounts exceed normal limits, or in settlement of accounts receivable. Determining the maturity date depends if the note is expressed in terms of months, days, or years. The formula for computing interest is face value or principal multiplied by the annual interest rate multiplied by the time in terms of 1 year. To illustrate, Betty Company lends Wayne Higley $10,000 on June 1, accepting a 5-month, 9% interest-bearing note. The journal entry Betty Company records on June 1 is an increase or debit to notes receivable and a decrease or credit to cash. Wayne Higley, on the other hand, would record a note payable. Assuming Wayne Higley pays the note on the maturity date 5 months later, the notes receivable is honored. The journal entry recorded by Betty Company is an increase or debit to cash for the maturity amount, which is the face value of $10,000 plus $375 interest for the duration of the 5 months, calculated by face value of $10,000 multiplied by the given interest rate of 9% multiplied by 5/12 because the interest is earned for only 5 out of 12 months. Because the note receivable is collected, it will be decreased or credited for the face value amount. The interest of $375 is recorded as a credit to interest revenue. Assume the same facts on the note receivable as on the last slide, except that the company prepares financial statements on September 30th. 4 months of interest, June through September, needs to be recorded on September 30th. The entry is to increase or debit the interest receivable and record interest revenue as a credit. The interest amount, $300, is calculated by face value of $10,000 multiplied by the 9% interest rate multiplied by 4 out of 12 months. The entry to record the honor of the note on the maturity date of November 1 is an increase or debit to cash for the maturity amount of $10,375. The note receivable is reduced or credited for the face value of $10,000. All interest has been collected, so the interest receivable, an asset, is decreased or credited for the $300 recorded on September 30th. The journal entry is not in balance yet, as there are debits of $10,375 and total credits of $10,300. 4 months of interest, June through September, has already been recorded on September 30th. 1 month worth of interest for October still needs to be recorded. Interest revenue of $75 calculated by $10,000 multiplied by 9% multiplied by 1 out of 12 is recorded as a credit. The dishonor of notes receivable occurs when the maturity date is reached and payment is not made. If collection of the note is expected to happen in the future, the journal entry on the maturity date is recorded as an increase or debit to accounts receivable for the maturity amount, or $10,375. Because the company does expect eventual collection, it is necessary to reflect the receivable. There is no longer the note receivable, so it is reduced or credited for the face value. The interest receivable is recorded as a credit. Receivables are recorded in the assets section of the balance sheet. If the maturity date is less than 1 year, the receivable will be included in the current assets section. The gross or full amount of the accounts receivable, as well as the allowance for doubtful accounts, is reported on the balance sheet. Bad debt expense associated with accounts receivable and interest revenue associated with notes receivable are included on the income statement.